And hello, everyone. John Hutchinson with Traders Reserve, and along with Michael Schulman and our weekly Paycheck training webinar. We have a pretty big crowd filing into the room, a little over 112 people already, so glad to have all of you with us here tonight. This is a live webinar. It is 7:30 p.m. Eastern Time on Monday, November 24th, 2014. And to prove that it's live, for those who always love to doubt us, the Ferguson Grand Jury will be making their announcement at 8 p.m. Central Time. That's 9 p.m. Eastern Time tonight. So we'll try to get everybody out in time. I'm sure that will be riveting television tonight. But more importantly, here tonight, we're going to be talking about you and your income and the next several years, especially if you're an investor who is dependent upon their portfolio for income. I have, of course, my special guest, Michael Schulman. You've most likely read our emails, watched some of our videos, if not all of them, some of them. And we have a pretty interesting presentation for you tonight. I want you to take notes. Feel free to ask questions. We will stick around and answer as many questions as we can tonight. And
John, can you do a sound check? Because I'm having some issues with your sound. Can you do a sound check with everybody?
Yes, I will, Michael. Thank you. But we will be recording tonight's webinar, and as we get started here, while we're getting started, if everyone just take a moment and type a yes or a Y into the chat box to the right, and just let us know that the audio is coming through okay and that you can see the screen, which should just be our title slide for the presentation here, Selling Weekly Options for Instant Cash. Now that'll take about 30 seconds for our sound to catch up to you, and in that time I'll make a few last-minute administrative notes, and then we'll get underway here. But more importantly, again, just let us know that you can hear the audio okay and see the title slide on your screen. As again, the webinar tonight, running time will be about 30 to 35 minutes. We will stick around after that to answer as many questions as you folks have. And Bruce, Henry, Eric, Dennis, David, Bill, thank you. Everybody seems to be hearing us just fine so far. If you do have any kind of an issue with your sound or with the presentation freezing, this is a sort of a backdoor to Google Hangouts, so naturally we're not 100% in control. Best bet is to simply log out and log back in. Usually that will solve the problem. If you happen to be on a Wi-Fi system, sometimes those will freeze up or hang up, if you will, and so the best bet is just exit and re-enter the webinar. Again, the chat box is open for questions, just to avoid as we're going through the presentation here tonight, we have to focus on what we're talking about. So you can load up questions anytime, and then we will circle back and answer them at the end of this presentation. We will have a replay of the webinar tonight, so it is being recorded, and you should get an email about 2 hours within the next couple of hours after we finish. So if you miss anything, or if you have to leave early for any reason, please feel free to watch the replay, and you'll be able to catch up with us then. So without further ado, let me introduce Michael Schulman. He is our options income blueprint expert. He's been running this program for over 4 years, successfully helping investors just like you generate more income from their portfolios than they ever thought possible. Michael?
Thank you, John, and thank you, everybody. This should be a fun night. This is something that I hope you're going to learn a lot. I hope I point you in the correct direction, because I was just finishing reading an article about an analyst in BlackRock talking about the falling yields in traditional dividend investments and the dangers growing because they're in an overbought situation. So to that point, if you're a trader or an investor who, like many people, struggles to produce consistent, predictable income from your portfolio, if you're sort of angry, if that's the right word, about zero yields on bonds, and low yields on dividends and money funds, if you're frustrated by losing money when you trade options, which typically means buying options, and if you're just simply put hungry for a simple and very successful way to put more cash in your account consistently, then stick around. This is a short presentation. I'm going to give you a proven strategy you can use to turn every Friday into an extra payday using weekly options. I've developed a simple plan to follow. It's low risk. It's a very high reward trading strategy that can, depending upon your position in life, restore your retirement capital and protect overall your really precious capital in your portfolio. To put hundreds of dollars in cash in your pocket, perhaps more depending upon the size of your portfolio, every single week. to end the income frustration I just spoke about and turn your income dreams back into reality. And best of all, this at its most would take but 30 minutes a week. Those who follow a simple low-risk weekly options income strategy, based on the surveys we do from one of my services, are averaging over $250 a week in total income based on a typical portfolio size of the survey respondent. That's a real extra payday, at least where I grew up. And in my last 4 closed put positions that were closed over the past 3 weeks, following my strategy, we had a good run. You could have put $457.70 per week into your pocket. That, if you do some math, is $23,816 on an annual basis in additional income. And I'll bet you're missing out on most, if not all of it. And it's time to change all that. First, let me introduce myself. I've been in financial markets for 30 years, more, as an investor and a trader, as a financial analyst and a financial writer. I'm a published author. I have 2 books you can get on Amazon, Sell Short and Made in America. I'm a financial writer. I write articles for Traders Reserve. I write them for Seeking Alpha, for Microsoft Money, for Investor Place, and so on. But more importantly, as John alluded to, this service is almost 4 years old. I've been helping investors like you master a simple low-risk strategy of selling options, and I call it my simple low-risk strategy because I developed it out of my own needs. That's right. This strategy is not about buying options. It is about selling options. Okay, it is about selling options. And it started about 5 years ago. A little bit more than 5 years ago, I faced a looming income problem. I have twin sons, and they were about to enter those really expensive liberal arts colleges that are absolutely marvelous places, regardless of what you might be reading in the headlines. And I discovered I had a couple of choices: to use too much of my retirement account, way too much, and hope I could make it back later on in the game, or develop a repeatable system for making money from my portfolio so I never had to dip into the principal, the core capital of that account, while never putting my portfolio at risk. What was my solution? To sell options, and specifically I quickly migrated to selling weekly options. Now, please don't run away. Don't think, I've lost money, this is an options thing, and you're thinking about income. Yeah, most option buyers do lose money for 80%, actually more than 80% of all options expire worthless. But think about it. If an option buyer is losing money, who do you think is making money? It's the option seller. And that's something I call the flip. When you sell an option, you're producing instant cash. It is yours to keep. It's in your account. When you collect that cash by selling an option, could be a put or call, you're transferring the risk to the buyer as you take their cash. Now, most option traders are buying risk when they buy options. Please, this is not what we're about. Do not do this. Sell options instead and flip that risk to the buyer. And here's why this is so important. As I said, more than 80% of all options expire worthless, which means the buyer loses all of his or her money. And the seller, as the seller, you keep all or most of the buyer's money. Plus, as an added cash benefit, when you sell an option and it expires worthless, think about it. You have no commissions. You're paying a 0 commission to close out the trade. You don't pay anything to buy back the option. And this makes selling weekly options ideal for smaller account holders. Weekly options, you may be aware of, are a relatively new tool, but the choices are growing rapidly, with many hundreds of stocks, indexes, and exchange-traded funds have liquid options that are also traded by the week. And now the number is over 400. When I began, there were 50. And again, it's stocks, it's ETFs, and it's index options. Now, the premium prices you get for these are lower than a monthly because they have such a limited shelf life, but they add up quickly when you are doing this week after week. Selling weekly options can quickly translate into putting consistent cash into your account week after week. You don't have to hold an option for months on end. By Friday, your weekly option trade closes out, tally up your total paycheck for the week. And as you might guess, for those of you familiar with the term time decay, the loss in the value of the option over time, even if a stock does not move, with weeklies, that time decay is ferocious. But that's a very good thing for the seller of options because that decay is what causes most weekly options to expire worthless. So why do weekly options work so well for option sellers? Well, let's look at some recent examples. EOG Resources is a fracker. The company extracts oil and gas from shale, mostly in Texas, and it's a sector and a company I follow very closely. On Monday, this past Monday, a week ago, I recommended selling $92.50 puts expiring at the end of the week on November 21st. We received 50 cents per share, and it's a contract controls 100 shares, so that's $50 per contract. At the end of the week, the stock was up. It was trading above $101. The put expired worthless, no commission. We kept the $50. Now, if you do this 50 times a year, you're netting $2,500 on a $9,250 placement of your capital. The week before, we sold puts, the $51.50 November week 2 put on another company doing a different thing but in the same sector, an oil field services company, Baker Hughes. And this, for those of you who are aware, is before the deal that they made with Halliburton. It was a very boring, very typical trade for us. We received $33 per contract. On Friday after the close, the stock was trading above 58. We knew the only thing we had to do with our cash was to spend it or reinvest it in our portfolio. If you had been a seller of 3 contracts, you had just pocketed a quick $100. And the way you do the math on something like this, it's about a 32.4% annualized return. And last week, I also recommended we sell a monthly option on Gilead Sciences. The ticker symbol is GILD. A monthly, you may ask? This is about weeklies. Well, you can turn any option into a weekly. Weeklies are not confined simply to those that expire at the end of the week. You can trade monthlies as if they were weeklies as long as you're willing to buy them back before expiration. Gilead Sciences is an income investor's dream. It's a biotech company with a new hepatitis C treatment that costs roughly $1,000 per treatment, and this treatment can cure up to 90% of treated patients. A one-of-a-kind drug, the fastest-selling drug in recorded history. A full course of treatment can cost up to $100,000. We sold the December $100 put with a whopping premium of $4.40 or $440 per contract. 4 days later, I sent an alert to members recommending, hey, this was working out faster and better than expected. Let's close the position. So we turned it into a weekly option. The profit was $140 a contract, 1.7% return in just 4 days. That means if we did this 50 times a year, we could theoretically generate a 70% annualized return. Or if you look at it in a different way, in terms of cash, if you'd sold just 3 contracts, you would have generated $420. That is the power of selling weekly options. These are the trades we did just the last 7 or 8 or 9 trading days. That's the power of it. It's an option you intend to close within a week, and it generates that extra cash and creates extra income from your portfolio. And here's a few reasons you should consider selling weeklies right now. Weekly options, of course, generate the weekly cash you want. They stretch your capital. They stretch the way you use the cash in your account. They stretch the way you hold your core assets, your core stocks that you like. Why? How do they stretch your core assets? You might own Apple or General Motors. You may want a dividend or a larger dividend. Well, create your own. Don't just sit there. You sell calls every week. Many of you may know an individual stock very well, so you leverage your familiarity with that stock. You know what underpins it. You know how it trades. You can use this to your advantage, not over the course of watching the stock over a year, but you can use it to your advantage every single week to generate income. And selling weekly options is a very low maintenance process. You sell the put or call. For calls, you place a good until canceled order in the system with your target price for buying back the option should you not think it will expire worthless. And you keep all the cash come Friday when the option typically expires worthless. So again, why do it now? Today's market is a stock picker's market. At any time over the past 15 to 18 years, stocks have never moved farther away from the indexes on a given day than they are right now. That translates into you being relatively immune from certain kinds of movements in the indexes if you pick the right company. In stock, this is ideal for a weekly options income strategy. This greatly reduces any risk that may come from a movement in the indices. In today's market, you can also readily find that great core stock, or stocks of course, with solid fundamentals, a great story going forward, and very rich premiums on their weekly options. You can then build cash, build income, selling weekly puts or weekly calls. Why does this work so well? Because you are selling what the majority of people, actually the vast majority of people, are looking to buy. Both professionals and retail investors love buying options. They're willing to risk their capital for that potential grand slam big payoff, or to use some of their capital to hedge or balance other positions in their portfolio. They use options, including weekly options, as a primary tool, and they buy them. So sell them what they want. And if markets become more chaotic, those traders pay more for the very same option. The more chaos, the more volatility. And the more volatility, the higher the price those buyers are willing to pay for an option, be it a put or be it a call. And perhaps the most important reason to think of this now is to shift this kind of income strategy that you're currently losing away from risk. As I said today, BlackRock came out and spoke of the significant risks in high-yield investments, a bubble in high-yield investments, and falling dividends. But overall, markets today, as they always have, continue to have a significant amount of capital risk, especially those high dividend stocks. And they will really take a hit when interest rates rise, or even a rumor of interest rates rising hit the market. What you have in these traditional income investments should be either supplemented or replaced with a much higher yielding strategy of selling puts and calls, a strategy well removed from the movements of the indexes or any one given sector of the market. The bottom line, you should be selling options every single week and racking up extra cash, because as the seller, you have the advantages. You get instant cash, you have lower capital risk, and fewer commissions. And when you learn my simple, repeatable strategy, you'll be able to enjoy the thrill of giving yourself an extra paycheck every single week. It's how my wife and I put our two sons through college, and I'm proud to say they graduated this year. But still, realistically, you're probably wondering, how much can you realistically make? So here's a snapshot of trades, not just from the past week or so, but because they were concentrated a bit in energy. Here is a snapshot of trades from the summer in a very close period of time together, one after the other, that highlight the diversity of stocks you can use to generate income. The examples are coffee, travel, and high tech. I hope that's diverse enough for you. Starbucks is and has been one of my favorite stocks to sell weekly options against. It is a stock worth owning or trading, for it sells, as you know, a lot of expensive high-margin coffee, and did so even during the Great Recession. This trade was built around an upcoming earnings announcement that had Wall Street quite nervous. I thought their business was in great shape, in part based on Chipotle's blowout earnings. I felt that spelled good news for Starbucks. Why? Same customers. Same potential issues of rising prices, which Chipotle's customers ignored, and I knew Starbucks' customer ignored. A same eco-ethos, and the same customization of your order. We sold the Starbucks July weekly $78 puts for $90 per contract. 2 days later on Friday, those options expired, worthless. We kept the entire $90 from the contract, 2% in 2 days, do it 50 times a year. Admittedly, this was an event trade, and that's 100% annual return. Around the same period of time, on July 30th, I could see that really good things were happening in the travel business due to increased income among Americans in particular. I went to a company in stock in the middle, not just of a great run with their customers, but in the middle of a merger that would greatly reduce overhead and some operating costs, and that company was American Airlines. I recommended selling the American Airlines August week 1 $39 puts for $32 a contract. Then, and please pay close attention, geopolitical pressures and the murder, the tragedy of the Malaysian Airlines crash in Ukraine took place, and all the airline stocks sold off. They all took a big hit. We were forced to roll the position. That means buying back the initial put we sold and selling another one at for a future date. Often, this means actually increasing your cash, and it did so in this case as well, increasing our cash by almost $1 to $1.36 or $136 a contract. So we rolled the position into the August week 3 $39 put. The airlines bounced back in a very short period of time, and we bought back that put, depending upon when we did it, for between $30 and $35 a contract, ending up with a $100 profit per contract. Of the 3 diverse trades, this is the last one. This is SanDisk. It's the world's leading maker of something called NAND flash memory, the form of memory found in smartphones and tablets and some laptops. It's the big dog. It's the market leader, has been for many, many years. Their margins were expanding, demand is strong, and the premiums and the calls are very, very good. So in the last week of June, with SanDisk trading around just shy of $102, we sold the June week $401 put for $57 a contract. 2.5 days later on Friday, the puts expired worthless, and that $57 stayed in our pocket. So if you were using $20,000 in capital, I've highlighted 6 real-world trading examples. This is the kind of profit you would see in total across a period of time that was no more than 4 or 5 weeks. I made this list from the 6 examples in this. Of course, in the services that I run, it's a much, much, much longer list of positions. If you had $40,000 in capital that were using and deployed in this manner, that's the kind of profit you would have made from these 6 positions that were not cherry-picked. They were the 3 most recent and 3 in a clustered period of time in the summer that showed the diversity of stocks that are available to you to use this strategy. So what stocks, as long as you're here, everybody loves to talk stocks, what stocks look good right now to sell weekly options in the coming weeks as the holiday season and the New Year approach? I still like American Airlines. The stock is now above 43. It's still enjoying increased operating margins from the merger with US Air. It's slowly over time, but that's just sort of gravy because, like all the other airlines, it's enjoying the run of more capacity being used and higher prices. I still like SanDisk. This is an iPhone Christmas. This is an iPhone holiday season. Tremendous interest in electronics and not just Apple's. You can't. It doesn't get better right now than it does for SanDisk. And speaking of that, Apple is really building a firm foundation, selling at an all-time high, and it's in the first leg of a major move up. And of course, the best stock right now is Gilead Sciences. It's 40%, selling at a 40% discount to the S&P 500. It was a huge company to begin with, and it doubled its sales over the past year because of new drugs. And for purposes of disclosure, I own and/or trade right now all 4 of these stocks. So as you can see, I'm using this strategy not in a speculative way. These are well-known big gorilla names. These aren't penny stocks. These aren't high-risk names. The foundation of what you should be doing and that I do are great companies and great stocks. And once you master my simple strategy, you should be able to spend less than 30 minutes a week selling weekly options. And not only is the option selling strategy simple, it's so effective that 93% of my followers who use it make money with it. And I know that stretches credibility. You know, you're used to seeing many things with big numbers about success rates. And sometimes I step back and I want to hear from people, and I get a lot of unsolicited emails. And this is an email I received pretty recently, and I have an email relationship since I received this with this gentleman. And as you can see, he's made 97 trades and 96 have been profitable. And this is not extreme. This is within the range of what you can do selling weekly options. And the bottom line is, however you take this in terms of generating income, this should be part of your investing and trading toolbox. That toolbox has to include your investment savvy and it has to include trading savvy, especially if you want to generate income and you want to trade for income. And that's why I've created a complete training program on selling weekly options. It's a program, as I said, for investors and traders, basically investors who trade, with any level of experience. People taking the program can start paying themselves regular, consistent income from their portfolios. And today, I'm going to do something I hope you've never seen before. This week, I'm going to teach you my complete selling weekly options strategy. I'm going to show you the 90-minute online training program. It'll teach you the exact steps that you can use to put hundreds of dollars of cash in your pocket every single week. The program itself includes what I have designed as the right way to sell weekly options to generate instant cash every week in a low-risk way. It includes 4 keys to selecting the right stocks, the correct stocks that you need to find to sell weekly options for that extra cash payday. It has a 5-point checklist for picking the best weekly option contract strike price, which is important as you go through the process of constructing a trade. And I guess it's ridiculously simple, and it's certainly profitable way to prevent losing trades, which you have just seen in the past few moments as you saw what happened with the American Airlines trade that went south for a few days because of a geopolitical event, the tragedy with Malaysian Airlines. We ended up actually making more money in the process of preventing a losing trade. Now, along with the core education and the core guidelines, the meat of what goes on in the online training, as soon as you sign up for the program, you're also eligible to get a companion strategy guide called Selling Weekly Options. You get cheat sheets for the individual piece parts of the strategy and the individual tactics you will be using to construct a position, a sheet you can use side by side as you get started and before you become perfectly fluent in using these kind of tactics. You get, of course, all the training slides from the training session itself, and you'll get a full recording, and these were a lot of fun, of a recent live webinar, so you can watch it over and over to do it again if need be. Now, when you complete the online training program, you'll hopefully walk away with a complete strategy to start paying yourself that extra paycheck every Friday. Now, you'd probably expect to pay a lot of money for this, and there are training programs in the thousands for something that is of this length with these kind of materials. Maybe you're used to paying $250. Perhaps you've seen something on sale and it's $100 or $49 or what have you. Not today, not tonight. My live Selling Weekly Options training program is available this week only for the equally simple price of $7.95. $7.95. I want to repeat that. And that's right. There's no catch. There's no 15-day tease. And then I want you to do this, and you have to do that. There's nothing you have to do to get incremental access to make the program effective. There's no teasers. There's no hooks. That $7.95, since we were talking about Starbucks, is actually less than the cost of 2 double lattes I had to buy today since my twin sons are both home for the holidays at Starbucks. Now, this price was created to make this a simple choice for you. Should I spend 2 lattes, actually less than 2 lattes, to learn a simple, safe income strategy? A strategy you could use, that I use to put cash in my pocket every single Friday. A strategy that I learned and that you can learn quickly without having to spend thousands of dollars to do so. So think about it. If you're still struggling to get consistent income from your portfolio, measured by the week, perhaps measured by the month as well, or are you simply wising up and becoming increasingly afraid of the low interest rate environment that's really has wrecked and is continuing to wreck many income investors right now? I urge you to please learn this simple, powerful options trading strategy. I really believe, honestly believe, this could be the best $7.95 you will ever spend to master a simple trading strategy that should pay you back every week for the rest of your life. Using 4 years of experience in publishing and working with members and my own personal experiences that go back years before that, I look forward to sharing that with you. I look forward to teaching you how to put that extra cash in your pocket every Friday. So, if you will, this is the link. I believe the chat box may also be in the link. The link may also be in the chat box. You can reserve a place now. It's $7.95. And I know people are probably typing, and I'm going to kick this back to John because this now may be the most fun part for some of you. This is the question and answer period that I look forward to.
Thanks, Michael. We do have quite a number of questions, and we'll start rolling through those in just a moment here. Folks, there are 3 different ways to get to this one right now, so we'll try to make it as simple as possible. First of all, there's an admin notice link that you can click on that should take you directly to the $7.95 checkout page. There's also a link in the chat box itself, and there's also one under the pop-in box, which appears up above the or over next to, the chat box. So any of those 3 will get you to the checkout page. I know it sounds like a ridiculous price, and we'll talk about that in just a little bit. But there have been a number of questions that have dealt with this one issue. Michael, I know you love to debunk this one and explain why this is not the case. But we've had about 7 different people ask whether or not these are naked puts.
Oh, yes. Thank you, John. John and I go back a long way. We yell at each other. We scream at each other because we both argue about stocks all day long because John is a great stock picker. The one thing we can agree on is, folks, there ain't no such thing as a naked put. That's a term brokers use. I think they developed it to scare people away because they'd have to actually be at their desk and do work and not be taking people out to lunch. And these are called cash-secured puts. You cannot... And maybe some hedge funds have permission to do so from their brokerage house. And it goes against a lot of SEC regulations. You can't sell put without collateral. So what these are, in a retirement account, it would mean you have to have cash. In a regular account, you have to have cash or margin. If you sell a General Motors $32 put, meaning the strike price where you would have to buy the shares if someone exercised the put was $32, it controls 100 shares. So you have to have $3,200 in collateral. Now, you're not buying anything. You're not spending any money. But it's $3,200 that has to remain in your account until the put expires. And with a covered call, in case anyone's asking about naked calls, you have to own the shares. And I do know runs of the early 2000s, a little hedge fund that sold naked calls, that got permission to sell naked calls on a little what they thought was a garbage biotech. It turns out it really was, and everybody thought it was, and they sold calls. And then that little garbage biotech, which was making artificial blood, talked their congressman into getting them a small Pentagon contract, and these guys got completely blown out of the water because they had to come up with the shares. So even if you have an opportunity to do a naked call, please don't do it. So they're not naked puts, they're cash secured puts, and they're not naked calls, they're covered calls.
All right, now let me take care of a couple of administrative notices here. First of all, the $7.95 is a one-time total access price. Again, it's not. There's no service. You're getting the entire education around selling weekly options, including all of the modules, add-ons that Michael expressed or explained to you. They're also detailed for you on the checkout page. So again, it's the total $7.95, the best $8 you'll ever spend. But it is a one-time price. You don't have to pay more. There are a couple of other options for you that you'll get as you go through the service with Michael. As you go through the training with Michael, as part of his overall Options Income Blueprint service. But for those of you who want to make sure that selling options is right for you, that you have what it takes, that you want to understand how to do it. This is the lowest cost to get the education that you need, and it's far better than any education you'll ever find free online. Now, in addition to that, I want to make a couple of quick notes for the folks who are asking about portfolios and IRAs, etc. In order to effectively sell options, you honestly must have at least $10,000 or more, and preferably more, in your account. And the reason for that is, as Michael expressed, if you are selling a weekly option on a stock that has a $50 share price or strike price, you are going to have 100 times that share price in your account in order to secure the selling of a put. or 100 times the share price to own 100 shares if you were selling a covered call. So honestly, one of the questions, I think it was from Joe, if you have our average portfolio size for most of the people who follow Michael in his actual service, the Options Income Blueprint program, is typically around $30,000. Those are, you don't have to have, you don't have to be a millionaire to do this. This is one of the things that folks have really, for $8, learn and understand why you don't have to be a millionaire to be able to make money from the market. And as Michael said, you're taking money from people who want to give it to you. But yes, you do have to have enough capital to be able to do that. So if you don't have a portfolio, if you are undercapitalized or underfunded, you need to be patient and grow yourself up to that $10,000 and higher mark so that you can start taking advantage of selling weekly options, even if you're just using that cash that you generate on a weekly basis to grow your portfolio so that you can sell more options so that you can make more cash.
And if I may add to that, you saw the numbers in here about the kind of cash you could generate in a $20,000 account. Well, all of those, every single position you could have done with a smaller account. It just means, you're more exposed. It may be the only position in that part of your portfolio, but every single one of those positions could have been executed. I think John's right. I think $10,000 would be the absolute lowest amount where you can do this efficiently and comfortably, which is probably even more important than efficiently. But as you go up the food chain, you can put on more and multiple positions or position.
A couple of quick notes here. David, regarding your question on secure payment advice on the subscribe page, I'm not quite sure what you mean. That is an SSL or secure socket layer page. It's an encrypted page, so your payment is 100% secure. If you were asking about something else, please feel free to expand on your question because I'm not sure that I understood it outside of that context. A couple of other questions here, and folks are asking about the additional service for Options Income Blueprint. We'll come back to that in just a few minutes. Michael,
don't leave. We're going to talk about it.
Yes, we will. You can do this in an IRA, correct?
Yes. In terms of broker selection in your accounts, I do this only in my retirement accounts. There's nothing special. If you have a good broker, and that's broadly defined, they may ask for another piece of paper for you to sign, which I think I did in one of my accounts. If they really give you a hard time, it's time to move on because it's based on their own internal discomfort. It has nothing to do with industry standard practice. And let me take that a step further. All the big and medium-sized online brokers do this as a reflex. For example, my broker, and I don't recommend any brokers, but my broker is Options Express, which is owned by Schwab. The term roll is even on my position page. So this is very, very industry standard practice. The tactics that are used here, it's very straightforward. So if for some strange, like if you have a small terrestrial obscure broker like Wells Fargo or something like that, that has I used to use, I still have money actually at Wells Fargo. Anyway, and they're giving you a hard time. Move on, because it means they're really not treating you well as a customer. But you can absolutely do this in a retirement account.
All right, let's address a couple of people have said, why is this only $7.95?
Oh, thank you. Actually, that's a question that I get more often than you would believe, and I've gotten this at dinner parties where people are asking me what I'm doing, why do you write free articles, and why do you do this? And I don't really mean to sound like a Boy Scout because I'm certainly not. I'm from Brooklyn, and that pretty much should tell you everything you need to know about my inner child. But I really, truly, I've enjoyed success with this. I've been a writer a good part of my adult life, and I've been a stock picker a good part of my adult life, and I really, truly, honestly just want the most number of people possible that have an interest in income or cash generation or both to be able to do this. And one of the reasons we're doing this now in particular is we look back on the past 5 years and the crash in interest rate, the crash in yields, the crash in stocks. Not the crash in stocks, but the dead yield business and the overpriced REIT business and the falling dividend. It's all going to happen for the next 5 years as well. It's very, very important. The one strategy that I know, that from my personal experience, both in my own portfolio and in what I've seen in the almost 4 years of doing Options Income Blueprint and for the past year, advanced coaching services with small groups of people, is that this works. This just flat out works. And it worked in the summer of 2011 when some crazies in Congress threatened to renege on the debt and shut the government down, and Greek bus drivers were burning buses and everything was chaos. We made more money because of the volatility in the market. So when we discussed putting this out there as part of the whole part of my personally being a professional involved in delivering investment advice, I said, hey, come on, let's do this. Let's make it accessible. $7.95 is basically a cost-covering price. And the bottom line is I wanted to put this in the hands of as many people as possible. And hopefully you know people who feel the same way about their own avocation, be they a baseball player or a stock picker or a doctor. Plenty of doctors do free lectures and they do free health groups, and policemen take time off to instruct people on home safety at town hall meetings on their own nickel. This is what I wanted to do. I found this to be successful. It solved a big problem in my life, and I really just wanted to make it accessible and hope that other people could share in what I've learned. And this really could, this is 2 lattes. This could be the best $7.95 you really ever spend. So I hope you understand I'm doing this. It's sort of an adjunct to life's work of providing advice to people, and this I thought was the best way to get the word out to people such as yourself.
Righty, let's move on to a few more. Folks, again, asking about the Options Income Blueprint service that Michael runs, which is on top of, or an extension of, the training program here. Again, we'll come back to that in just a couple of minutes, but I do want to get it down to some basic level questions here. Nancy had asked, where was it? To trade covered calls, you have to buy the stock. Yes.
Yes.
You have to buy 100 shares of the stock in order to trade a covered call.
Yes, it's 100 shares per contract.
Here's a good question from Robert, Michael. It says, do you use a lower strike price option to protect your position and to reduce the margin or cash to put up or not?
Can you repeat that? You sort of faded out a little bit. I'm sorry.
Yep. Do you use a...
Can you repeat the question?
Do you use a lower strike price option to protect your position and to reduce the margin or cash put up or not?
No. This is a strategy born of experience, and to the extent that we try to limit what you do to do spreads, things like that, rolling a position such as you saw in the Malaysian airline incident with American Airlines, over time is much more. There's no comparison. It's much more effective, and here's the reason why. People who limit positions are looking at a transaction focus. How am I going to do on this individual trade? I alluded to that we are investors who trade. It's a distinction with a difference. I like using that expression. And what I mean is this is based on fundamental stock picking. I mean, that's what you need to do. And a belief that the stock going to go sideways or going to go up, or if it's an inverse ETF, the market's going to go down, whatever, you have a belief. And then you're going to trade it very, very short term. These are weeklies. Even monthlies are short term. So if there's an aberration in the market, it is just that. It is an aberration that goes against your belief system. And therefore, you have to be prepared to do multiple transactions in the same position. And what I mean is the way you limit your risk here and your capital risk, the way you limit being put shares at a price higher than the market price, is by rolling. With overall positions in Options Income Blueprint, which a couple of people have asked about, last year, I'd say 15 to 17 out of 100 trades in calendar year 2013, we rolled. This year it's a little bit higher, but the net effect is the same, which is the typical roll doesn't last but more than a week or week and a half. Weeklies, it's far less. Weeklies are rarely rolled, and if they roll, they can often close them out in a week or two. In fact, an example I wanted to put in here, and I didn't, we had a Blackstone put. We rolled it, and I actually rolled it into the following month, which I got some emails, why are you going to tie up my money for 4 or 5 weeks? I said, we're not. We're going to close it very, very soon. But there was a very rich premium available, and it made more sense from an efficiency purpose to roll there. We closed it out in a few days, and we made more money. So when you have the track record that we have and the experience in doing this, what we look at is positions and managing a position that may involve multiple transactions, preferably not more than one, but let's say, well, it's not multiple, but two. And that is far more effective in generating high profits than limiting yourself to the downside through doing something, like you suggested. It's a better way of generating income.
Alrighty, a couple of other questions here. Let me knock these out here. Nancy asked, what is the success rate on the advisory service? It's currently running at 98%.
And if I may, that sounds like financial porn.
Yeah, it does.
It's not. John is not kidding. I know when I say this, may I, John? I had a couple of charts prepared.
Go right ahead.
Here is a screen capture. Didn't this come out clearly? Don't worry, I retyped it. These are the last trades that were closed from August, and here's the results. And you might notice that there isn't a loser there. And this goes back to the middle of August. It's all I could fit in a PowerPoint slide. And the reason is remember, we went through October, and we have some rolled positions, by the way. Those aren't closed. We have we have either 3 or 4 rolled positions that are open that I haven't closed, so they're not on this list. But they're not losses. We just extended the position. And you can see if something I like Gilead, I did it 6 times or whatever. This is about making money, obviously. And the bottom line here is I put the days. You can see how many 2-day trades we have. My guess is the 6-day trades were monthlies that closed early or positions we rolled and closed. And the reason I put this in is we don't often get questions about Options Income Blueprint when we do training seminars. But the last one I did, we had a bunch, so I wanted this prepared. This isn't, well, I guess we're bragging, but this is really to show you that you need to embrace this tactic. You know the market went down. You went down 6-point-something% in October. Well, take a look for yourself. This is from the middle of August until today, or last Friday, or Monday. No, today's Monday, last Friday. And this is all real. And so, in the middle of all the tumult, for example, Micron was going up because of the belief that a company they bought was going to be part of the iPhone 6 announcement. And people were getting in advance of it, and because of the way Apple does business, and because I knew about the company that Micron had bought about a year and a half ago to get into the iPhone and smartphone market, I thought from a fundamental point of view, Micron was going to reshape part of its business, so it's a fundamentally good deal, and the stock was moving in the correct. So during the correction, Micron did fine. Tesoro had done fine. That was a monthly. SanDisk. So you can do these things, and you can be market independent. So that's and the reason I put the screen capture up is to let you know I didn't make this up. I mean, you can use a microscope on that, but it just didn't work.
Let me step over you just for a moment, Michael, folks. And one of the things that I think you'll learn, especially even if you throw a few questions in right now into the chat box, as soon as this audio catches up to you, one of the things that you'll learn by listening to Michael is the reason he has such high success is because he is a fundamental trader first. He understands the fundamentals behind these companies. So when he makes recommendations to his members, he has a very good basis in fact for the price level he chooses. He has a very good basis in fact for the company that he chooses or the sector that he chooses. It is all based on his extensive experience over 30 years as a financial analyst, as a financial writer. So the key here, the reason that the 98% winning ratio sounds ridiculously high, the reason that it is that high is because he's doing these trades on good companies. Now, when you look at that list, $33 may not sound sexy, but if you sell 5 contracts, that's $165. 13 or 16 or 15 or $20 may not sound like a lot of money. You sell multiple contracts, but you do it every single week, and that money adds up. And let me remind everybody, in case you haven't been paying attention, in the last 5 years, yields on U.S. Treasuries down 60%. Interest rates on CDs, savings accounts, money market accounts, down 88%. Try to make income on a $100,000 CD. You can't do it. You have to take control yourselves. This is one method you can use. It is accessible to you. It is possible. And it is powerful. But it's up to you. So
And let's go back to training a little bit, and we'll go back to this button, and in a minute or two I'll talk about the content of options in the blueprint. But rather than get ahead of ourselves, to John's point, should you take the training and you go off and do stock picking? There's a zillion technical trading seminars, and I'm sure they're fine for day trading, parabolic, hyperbolic, Martian, Blue Monday, double spread, bull put, and I'm making fun. I mean, I've actually have two friends who I breakfast with a lot who are like hardcore spread traders. We always have fun because of their vocabulary. It scares the waiter away. But the bottom line is it does start with fundamentals, and that's why I made the emphasis between positions and transactions. If you take a transaction approach to this, you're going to incur too much risk. I got a question recently about would you trade oil, because ETFs typically don't have rich premiums on their options, and USO is the ETF for oil, and the premiums were super fat. And again, I got this thing I said, on its face, it looks great, but did you know OPEC is meeting on Thanksgiving? And there was dead silence. And I said, in addition to OPEC meeting in Thanksgiving, have you factored in the possibility, what if on the outside chance Iran and the United States reach a nuclear deal? The price of oil is going to fall, big time. Temporarily, it'll come back up, but the traders will get out of the position. So there are things you have to be aware of in the real world and fundamentals. You can't just work back. You don't work backwards from charts. Charts are the icing on the cake when we're doing this. When you take the training webinar for your $7.95, you'll see that it's very, very, I mean, there's like 30 seconds or 15 seconds worth of looking at charts to determine where support levels are, because these positions are only a couple of days. And a lot of the other stuff that you may look at when you're buying things or you're doing spreads are totally irrelevant. So, as John said, fundamentals are very important.
And Bill just had asked here, how can you justify selling a position for $16 as you show with American Airlines when the commission is at least half of that? And there are three answers to that one, Bill. The first answer is you walked away with a positive amount, even if the commission was half of it. The second is that $16 was based on a single contract. So if you had more capital, you could have sold 3 or 5 contracts without any more undue risk. And the third and most important point, and this is where a lot of people get mixed up, is these are typically, Michael, what was the number of days on that American Airlines trade?
Well, that American Airlines trade was 2 days, and we did something unusual. I remember the position. We closed it out on a Friday, which we normally would expire worthless because it was making me nervous. So it was recommended on a Wednesday afternoon, and it was closed out on Friday morning rather than let it expire worthless, because at 16, let's say you had a small contract position, an expensive broker. You're going to break even, you're not going to make any money, but you're not going to be put the shares. So one of the things, and we're spilling into options income blueprint again, I don't mean to do that, if you're doing this on your own, don't be greedy. If you don't like being put shares and you're only doing a put strategy, or that's part of your portfolio and you're doing covered calls in the other part, and it's Friday at 11 o'clock in the morning and the market's wobbling, and if oil prices go up, the airline stocks go down, and let's say there was a spike in an oil price, it's time to just close it out. So rather than roll that position, this was a repeat. You saw the American Airlines position from July. This was a position that came on about 2 weeks later. It was like, hey folks, we're out. I know you don't want to be put the shares. We're done. And several of these, I'd say the Expedia $25 one, the American Airlines 16, those two I know I closed early. And they were really just to break even and get out, so we weren't put shares over the weekend. And that's part of what I mean by viewing this not on an individual transaction basis, but on a position basis. You're managing a portfolio, you're assuming you're doing this 40, 50 times, 40, 50 weeks a year, with maybe even multiple positions in the same week. You have to protect your capital, and you don't want your capital locked up, so you take a break-even trade. You probably do it on stocks all the time. You may bet on an earnings event where you may see a stock that you thought was going to do well, not go, hey man, I can get out, I can break even, I can put my money somewhere else. And that's what that $16 position was for. Now, if you look at the other ones here, the way to look at this, this wasn't a marketing thing. This was just, I wanted to do a little sort of proof of life here that this tactic works week after week after week after week. If you did an annualized rate of return, which is really the only way, and that you learn in the training program, if you take a look, for example, at Tesoro, that was probably about a $65 or a $62 put. Stock now is $77.50, and I own it. And at $38, if you sold a $65 put for 1 day, okay, you made $38 profit. Multiply that by 50. that is $1,900. And you divide 1,900 into 6,500, the amount of capital you would have to put up, and you're looking at a 30 to 33% annualized return. The annualized return number when you're using a yearly program, and I'm sort of getting into the training itself, when you're getting into a yearly program and you're doing this, some people do it 50 weeks a year. I actually don't. I trade weeklies probably 40 or 45. There are times my head wants to explode, and I don't trade my own portfolio. Or I'll trade monthlies instead of weeklies. For example, in options, I can blueprint my own portfolio. There are no weeklies this week because of the light trading around Thanksgiving. But when you're looking at annualized returns on a transaction of over 30%, you can trade 40 weeks a year. You can trade 90% of your portfolio, and you're still going to end up with a 20 to 22% income gain on your overall portfolio at the end of the year. And so, as I said, I'm getting ahead of myself and sort of peeking into the training program. But these low numbers, which are bunt singles, and maybe the occasional double, if you want to use a baseball analogy, if you don't get anybody out, this is a 15 or a 20-run inning, right? This is a 15 or a 20-run inning in the first inning, which wins every game. And that's what this is all about. So I understand where the question came from, and I'm glad you could ask a trade that I remembered very, very clearly of why we got out. And remember, all the trades balance each other out. You're going to have some break-evens, you're going to have some rolls, you're going to have some extreme trades, like the Gilead trade last week, where we did 1.7% in a few days. And I even got an email, why'd you close it out? And I said, why do you want to tie up your capital for another 5 weeks? We can trade this again next week, but you have the flexibility. And that goes back to the flexibility that is included in the weekly options training program. You learn to be flexible, you learn to be light on your feet, and you learn the basics of what you need to do this for yourself.
A couple of quick admin notes again. First of all, the $7.95 program is up in the chat box here under my name. It has the weekly-paycheck/go. But I've also, for those of you asking about the Options Income Blueprint program, I'll give you some quick details on it. It is an entire education course on selling options, both puts and calls. It also includes the advisory service for selling weekly and sometimes, as Michael occasionally does, monthly options. But again, selling mainly puts. From time to time, you may do a buy right or a covered call. But typically, again, these are some of the questions. I'm kind of morphing a bunch of them together here. Typically, on an average week, Michael will open an option position on Tuesday or Wednesday during market hours. An email alert does go out to all of members, and we will also be rolling out text and SMS alerts within the next 30 days for members who would like them delivered to their mobile phone. We also have a member site, 100% member site driven, so you can get all the information you need either through text, ultimately, or eventually, email and or on the member site. Now, he makes those recommendations usually usually Wednesdays, sometimes on a Tuesday, for the weekly options. And the reason for that is he can also go into this a little further, but it's typically as the volatility is in your favor. So I think there was a question, for example. Go ahead, Michael.
Let me. I'm going to step on John for 2 seconds in a positive way. It goes back to what you will see in this training webinar, which is that at the midpoint of the week, perversely or conversely or inversely, some earthly, is sort of an ideal time to limit your exposure to the market, your exposure to an abrupt movement in the stock that you can't predict, and the amount of premium you want to justify your use of capital. So Tuesday or Wednesday, and I'll wrap up with a learning moment right here. When I sell covered calls in my own portfolio, weeklies, I sell them at the beginning of the week or the previous Friday because I'm willing to be called out or I'm willing to roll them. Covered calls are very different than puts that way. When you roll a call forward, you're always making money because it means the underlying stock is appreciating. It's a very pleasant experience. So I'm willing to take exposure to the market more to get the extra dollars that you get expires in 5 or 6 days rather than 2 or 3. John's dead on. I do my weeklies on Tuesdays or Wednesdays, typically Wednesdays. We do an average, if I had to average 1.5 a week, and if I had to average monthlies, it's 1 to 1.5 a week. In the Options Income Blueprint service, it's between 2.5 trades a week. You obviously don't have to do them, or don't have to do any of them. And some monthlies go to expiration, some monthlies are bought back early. Today, for example, was an update day. We do updates on Monday with a 1,000 to 1,500 a word look at the market, look at a particular issue. The issue today was we all should be giving thanks because it's going to be 2015 based on fundamentals that Wall Street continues to miss, which is the powerful importance of energy and the powerful importance of manufacturing renaissance. And has been suggesting an incredible website. We have excuse my language, maybe a 6-hour set of training modules with special features, which is a comprehensive course on everything you want to know about selling options, be they calls or puts, weeklies or monthlies, ETFs, indexes, what do you do in a bear market? It's all there in the training program. And then there are special modules on rolling and weeklies and what have you. And tying this back to this training webinar is, in a sense, this is a subset, or you could say that the training materials are a superset of what you will see in this seminar. And Options Income Blueprint Service, should you have interest in it, is what you would do to find ideas to be able to implement the tactics with instruction. Meaning John was right. The alerts that go out are line-by-line instructions on how to construct a trade. And what's the current price of the stock, so you know when you got it, what I was talking about at the time that I wrote it. What should you do, your range of what you should accept selling it for, what's your target price to close it if there is one, and usually it's 0, but yada yada yada. And the roll ones are the same way. If you have to roll something, they're very, very explicit. And if you really did the training, 6 hours of training or whatever, and they're broken up into modules of bite-sized pieces, the alerts would almost be a little bit redundant in terms of some of the detail, but the detail is there if you need it. And the training webinar here will give you a taste of how simple this is. This may have some new vocabulary for you, and I know hardcore options buyers that the thought of selling options is and these small returns that the gentleman pointed out is something you have to get your head around. And the training program there will help you get your head around it. This training webinar will help you get your mind around it, because you have to visually, in your head, look at your portfolio and say, I'm going to do this every week. So I'm going to shoot for 0.5% a week. Well, nobody shoots for 0.5% when they're buying an option. You have to be out of your mind, because with the risk of the option list, why bother? But when you're selling an option and you're doing it week by week, 0.5% a week is 25% a year. With very, very, very low risk. So you will get the big-time flavor of that and how to do it in this training webinar. And then when you want to move on, the advisory service with the training modules is there on Options Income Blueprint. Plus, with advisory service, like other things, it's a great website. I answer my emails, when you have questions. We do about one a month, John, of live webinars at night, strategy sessions to talk about stocks.
Yes.
It's fun. It's a real community.
We're going to wrap up with just a few last questions here, and I want to start with Perry's question, because he has a very good question, Michael. It was, say you had $100,000 or $200,000, how many different stocks would you be looking to trade, or would you just allocate $20 per stock?
You mean if you had a $200,000 portfolio, how many positions? I'm assuming that's what the question is, and it's hard to say, and I'm not punting. It depends upon your time, your risk tolerance, and it's funny you should ask the question, because there's an advanced coaching series that I do. That's the first session, is model portfolio construction, and it's in our boot camp and in the first session. And here's the answer: the answer depends on how many you can manage at the same time. Now, you don't want 10 weeklies all expiring at the same time, because let's make believe Iran announces it has a nuclear bomb on Friday morning. You're going to be put 10 shares, or you're going to be rolled into 10 positions, and your income goals, certainly for the week and maybe for the whole quarter, are going to be, pardon the pun, blown out of the water. And so when you have a large portfolio, you want a mix of weeklies and monthlies. And with a $100,000 portfolio, I think anywhere between 5 and 12 positions is a good comfort level. I myself, because of what I do for a living, I have concentrated positions because I find it very straightforward to manage. I can give you an example. Today, if you loved a stock that I know and you put $100,000 up to sell a put, an hour later you could have closed the position with a $400 profit. And if you do that, You do that once a week for 50 weeks, that's 100% rate of return. And I'm not suggesting you'll be able to do that, but when you have that amount of money and you have that kind of flexibility, you will make more money. I mean, you just flat out will, because you're going to be able to sort and sift if you get started with this and see what works well for you. Do weeklies work better for you as puts? Do weeklies work better for you as covered calls? Do a mix of weeklies and monthlies bring your boat, float your boat? Do you only want to do monthlies? This you'll have to work out. But in a $100,000 portfolio, in my coaching program, I tell people somewhere between 5 and 12 positions, a $250,000 portfolio, somewhere maybe up to 20. Now, I have a subscriber who has 175 open positions. I don't know how he does it. I could never do it. I have other subscribers that are as few as 5, which might make me nervous, and with very large, $500,000 portfolios. So it's up to you. But it has to start with your ability to manage, to absorb information, to keep an eye on things. And once you know what that is, then you start calibrating rates of return. The one thing I will say to conclude the question is, again, in Options Income Blueprint, I allude to this in my writing, and I share trends. I do non-Wall Street defined trends to find my stocks. They're called iWorld, Food Glorious Food, the top 20%. They're derivative, but they cut across Wall Street sectors. From those trends, I have 25 what are called bullpen stocks. And these are stocks that I love the company. I just love it. I love the stock, and I get very familiar with the way the stock trades. In your own portfolio, over time, you should create your own bullpen. It could be 3, could be 4, could be 2, could be 6, that and you can day trade them. There's nothing in the world like day trading a call at a strike price above your cost, because it's a free trade. There's no risk. I mean, I want you to think about it. You buy a stock at 40 and you sell a $45 call, you have no risk. So there are things you can do in a larger portfolio, especially with covered calls, that you're not going to do in a smaller one, both from efficiency reasons, and you can diversify your positions. Once they're diversified, you can find out what you're good at, and you can move to stocks that are moving on their own, and that'll increase your returns.
All right, Harry is spamming the chat box, and I'm just teasing Harry. I'm just kidding. Harry wants a free trade, so we're going to give him an example of a free trade here. Free trade information.
Well, I need to go out to the internet. Hang on a second.
Yep. So
I can tell you what my free trade would be without even looking at the internet.
But we're gonna do Harry's free trade.
He's giving us a free trade.
Harry seems to be in love with a company called BAC.
Bank of America.
Yep.
It's one of my bullpen stocks. It's one of my top 25 picks.
I knew it was, and so I figured you and Harry would have a good time talking about this. So let me give you a couple of Harry's total questions, the sum of his questions here. So BAC, his first question was BAC current numbers for selling the selling put or selling the put. I think what he's talking about is where would you look right now if you were selling a put against BAC?
Well, you can't. One of the problems with Bank of America is there are so many contracts open that there's no difference between the bid and the ask, which might seem good. It's at $17.18 at the close. The $17 put for this week would sell for 3 cents. So that's really not something you can do. When I started trading Bank of America, it's funny you bring it up, Harry. I have recommended once in 3.5 years selling an in-the-money put. That meant I recommended a put that odds were you're going to be put the shares. Meaning I recommended an $8 put on Bank of America when the stock was trading about $7.85. And I said, if you get put the shares, accept the shares and sell calls. In retrospect, it was a pretty good recommendation, obviously, because the stock's at 17. If you go out to the December, you can get about 20 cents for selling the December put, which is 4 weeks from now. And that's so let's do the typical crude back-of-the-envelope math. If you get 20 cents in a month, that means you're going to get $2.40 over the course of a year, and that is about a 15%. That's about a 2240, 12 3/4. It's about an 15 to 18% annualized return, which is the very, very low end of what I recommend in my service, because I'm assuming not everybody trades every week. So it's a terrific company, by the way. I bank there. And fabulous website, great customer service. The issue with that particular company is the gigantic. I'm looking at December $18 calls. There are 106,790 open contracts. So it's not going to get you to the advanced income. If you're shooting for 15 to 18% in your portfolio, you need to shoot for transactions that are doing 25 or better. And this won't get you there. I mean, this thing would have to be at like 1701 or 1702 in the market, the share price, and then you might get a fair price for selling the $17 put, but then you always stand the chance of being put to shares. So I'm with you. I love it. It's a great company and a great stock. It's just very hard to hit my own publishing goals and my own goals in my own portfolio with it. Now, if you're happy with a 15 to 18% return on transactions, then you could probably trade this all day long.
Which leads to the last question. What are, I know this is part of the training program, but what are some of the key criteria you use when choosing an option to sell, or a company that you're selling a put on?
It's a very good question. And it's a pyramid within a pyramid. The bottom of the pyramid, I've said before, trend, great company within that trend, great stock, meaning the stock is moving, it has support at certain levels based on charts and modest technicals, but then you're going to the options. And this is where there's an intersection with short-term charts. What you're looking at in a put, you're obviously going to sell an out-of-the-money put, meaning if the stock's at 35, you might sell a 34 or $34.50 put. What you want to look at, are they liquid? Is there a fair spread between the bid and the ask? So you're going to get a fair price, and also if you want to, for some reason, buy it back. Is the premium, the amount of money you're going to be paid, allow you to hit your goal for the transaction, which in turn rolls into your income goals for your portfolio? Those are the first two things. The third thing is, excuse me, I'm a little dry, I'm going to get a drink of water, is when you're looking at it, what are the support levels? And support is very differently defined. I hope you technical traders out there don't get sick to your stomach when I say this. You're going to look at the 3-day chart, the 5-day chart, the 10-day chart, and maybe a month. And you're not going to look at parabolic this, or you're not going to look at the Greeks, you're not going to look at implied volatility. You're going to look at where volume comes in. Now, most every chart and every brokerage service has bars that either come up from the bottom or come up from the side, and will show you where bulls and bears get into an argument about the price of the stock. Now, that doesn't really work with a 3-month position. You have to do much more technical work. But with a 3-day position, it sure as heck works. I've built a service around it. You should be looking. So let's say it is General Motors, and let's see what GM is trading for now. GM is currently trading for $32.19. Now, does that mean you would sell the 32 or the 31.50 or what have you? And of course, I'm looking at my chart, and it's got indigestion. Isn't that great? I love when that happens. I'm trying to be realistic here. And come on, man. There we go. So I'm going to look at the 3-day chart, and then I'm going to look at the volume flows. And the volume flow says we're capped out at 32. So if you own the shares, you're going to be very happy selling a 32.50 call. Now, if you're selling a put, there's not a lot of support when you're looking at this. The most is going to be around $32, and what you're telling yourself is this might not be a good trade when I look at General Motors, because if it doesn't hold at 32, it's going to slide all the way down, and the chain that I'm looking at for the $31 put, there's not enough money. So that's the kind of the thinking you do. Where is the short-term support? Where is the stock going to hold over an argument between bulls and bears? I know it seems like I'm dumbing it down. Trust me, it works. And again, because it's a 2 to 3 to 4 day trade, and it's based on top of an investment approach, which is I like the company and the stock. Now, if that chart, the volume had come out and said 31, doesn't mean you sell a $31 put. You might want to sell a 31.50 or what have you. You might want to, if the support is 25-50 cents, $1 below where you're selling the put, that's fine, because you can always roll it. And that goes back to multiple transactions for a position. If the premium is nice and fat and lots of cash, and you may get not put the shares, you may have to roll the shares for a week or two. but because that's where the support lies, and there could be some temporary downturn in the stock. Fine, the premium's justified being in the position another week or two because you're going to generate more cash when you roll it. So that's it. Look at the 3, 5, 10, and 30-day charts where the bulls and the bears, the volume flow comes into the stock. Now, there are aberrations. Holiday time between Christmas and New Year's, volume will be light, so it distorts what might go on for the 30 days that's included in that. But other than that, you pretty much get a really good idea in the 3, the 5, and the 10. And you can even use the 1 and the 2-day, and I take a look at those also, obviously, especially if I'm day trading calls. But that's what the pyramid is: fundamental company, fundamental stock, how the stock is basically moving, liquidity of the options, fairness of the premium in terms of meeting my goals, and then where is the support price if the stock starts to trade down? Where is it going to stop? Because if it stops even temporarily for a few hours where the bulls and the bears argue, it gives you a chance to close the position at break even or even a small profit. So that also creates a time window for you to be able to manage the position. So that's the most important technical indicator.
Alrighty, I think that will wrap our session up here. We went a little bit over our 1-hour time limit, but that's okay because, folks, you asked some terrific questions, and we really appreciate that part of it. Really enjoy the opportunity to take good questions and turn them into good answers. So, again, last chance here to get the weekly Paycheck training program. Again, this is a recorded training program. It does include cheat sheets. It does include online guides. There is also, I believe, maybe in our other service, the Options Income Blueprint, we also have a broker's guide that we're working on, and we should have that out to everybody sometime in December. But you can use any of the standard brokers found online. But more importantly, again, this is an opportunity for you to learn if this strategy is right for you without having to commit significant money to educate yourself. Learn to find out if you have what it takes to sell weekly options. And if you do, you're going to discover that they are a very powerful tool for you as an investor. So, Michael, I'll give you 10 seconds as a goodbye and thank you, and any last second thoughts that you have for the weeks ahead.
It's going to be a good end of the year. It's going to be a great 2015, and you should get ready to put on your investor's hat, but trade it for income.
There we have it. Okay, folks, again, the replay will be out to you shortly, so if anybody had problems or if you missed any part of this or if you want to go back, remember, the objective here was to teach you tonight why you should be using weekly options if you are an income investor. The how is in the $7.95 training program. The what stocks to trade, and the which options to use are in the Options Income Blueprint program. Once you buy the $7.95 training program, you'll automatically have an opportunity to join the Options Income Blueprint service. We just made that change over for you now. So as soon as you get in, you'll have an opportunity to take the typical 60-day trial that we do for the Options Income Blueprint program. You don't have to do it right away. We'll certainly offer to you again in the future. But more importantly, again, get in, take the training. It is high-quality training from Mr. Schulman, and it is some of the best that you will get online, even though it carries the outrageously low price of $7.95. It'll be the best $8 you spend this weekend, outside of the turkey, of course, which won't cost you $8 if you're lucky. So, for all of us here at Traders Reserve, I want to thank you folks for taking time to join us tonight, and we hope you have a safe and happy holiday with your families, and we look forward to seeing all of you in our training programs or our future services with Traders Reserve. Have a great night.